Most contractors can build $1 million project with 30 different trades, manage hundreds of line items, and coordinate deliveries down to the hour, but they can't tell you where their money went last Thursday. You got $50,000 sitting in your checking account right now, and somehow you're still nervous about making payroll next week. That's not a cash flow problem, that's a clarity problem. Let me show you how 6 simple bank accounts will fix that forever. I'm Wade Carpenter, CPA, and author of Profit First for Commercial Construction. I work with contractors every day who tell me the same story. Wade, I thought we were doing fine, but I can't figure out where the money goes. Here's what's happening. You're running everything through one operating account. Job costs, overhead, your paycheck, tax money. It's all mixed together like throwing lumber, drywall, and electrical wire in the same pile and hoping you can find what you need when you need it. Construction cash flow is nothing like a regular business. Your money shows up in lumps. When that payout clears, when retainage finally releases, when that slow paying customer gets around to it. But your bills don't wait for convenience. Payroll hits you every 2 weeks, whether that big draw came in or not. So you look at your account balance. Let's say $50,000 and you think that's flush. But here's the reality you can't see. $25,000 of that belongs to the Parker Street job for materials and subs due next week. Another $8,000 should be sitting there for tax obligations. $7,000 needs to cover overhead through month end. $5,000 is profit you haven't distributed yet. That leaves you with $5,000 of actual operating cash, not the $50,000 you thought you had. Profit First for Construction fixes this with what I call envelope system, but instead of paper envelopes, we use separate bank accounts, 6 of them. Each one has exactly one job, and it never does another job's work. Think of it like buying a house. You don't just dump all your materials in the middle of the lot and hope for the best. You organize, lumber over here, electrical there, plumbing in that corner. Same principle with your cash. Let me walk through all 6 accounts and what each one does. First account is income. This is where every deposit lands first. Customer payments, retainage releases, everything. Think of this as your sorting room. Money doesn't stay there, it flows through. Every week or every 2 weeks, you sit down and allocate that money out to the other 5 accounts based on the percentages we'll talk about in a minute. Income is simply the temporary holding account. It's the loading dock, not the warehouse. Second account is JobEx, your job expenses. This is sacred ground in Profit First for Commercial Construction. JobEx hold one thing and one thing only: direct job costs. Subcontractors, materials, job-specific labor you can track to a project, equipment rentals tied to jobs, permits, bonds, job supplies. If it's not directly tied to delivering a project, it does not touch JobEx. Here's why this matters so much. Most contractors pay subs out of the same account that covers office rent. When you do that, you lose all visibility into which jobs are actually profitable and which ones are bleeding you dry. Your overhead secretly steals from job money and you don't see it until it's too late. JobEx creates a firewall. Job money does work. Third account is your OpEx, operating expenses. This is your overhead, the stuff that costs money whether you have jobs running or not. Office rent, administrative payroll, insurance, software subscriptions, marketing, your truck payment. And here's where PFCC gets realistic about construction. OpEx includes your loan principal payments. Now, your accountant will tell you that principal isn't a P&L expense. It's a balance sheet transaction. And technically, yes, that's true. But your bank account knows that money's leaving. OpEx capture the truth, what it costs in real cash to keep your doors open every month. When you separate OpEx from JobEx, true costs of staying in business, independent of how many jobs you're running, that clarity changes everything. Fourth account, owner's pay. This one's personal. Owner's pay gets funded every week or every 2 weeks, same rhythm as your employee payroll, no exceptions. No, I'll pay myself when times get better. No, I'll take my draw if the money's left over. This breaks that contractor curse of paying yourself last and finding nothing but crumbs. You know that airline safety speech? Put your oxygen mask on first. Same principle. By syncing owner pay to payroll rhythm, it becomes automatic, not aspirational. You're not hoping to pay yourself, you're guaranteeing it because the system funds it before overhead gets a chance to eat everything. Fifth account is tax. This covers income taxes only. But here's the key move in Profit First for commercial construction. You park this account at a completely different bank, not just a different account number, a different institution, across town if possible. Why? Because of Thursday afternoon at 3 p.m., when payroll's due and your main account looks short, and you're thinking, I'll just borrow from the tax account this one time and pay it back next week. When tax money requires a conscious decision, calling another bank, logging into a different institution, waiting for a transfer, that friction gives you time to think instead of panic. It's practical psychology. Distance creates discipline. Account number 6, profit. This is your reward for running a healthy business. Profit accumulates monthly, but you only distribute it quarterly and only when it aligns with project completions, retainage releases, or major milestone events. Why wait? Because construction cash is milestone driven. If you distribute profit in March based on work you did in February, that retainage doesn't release until May. You're spending money you haven't truly collected yet. Then comes May, retainage delayed, and you're scrambling. PFCC aligns profit distributions to actual cash realizations. When the money's real and in your account, then and only then you take your profit distribution. Let me show you what this looks like with real numbers. Say you collect $40,000 this week from the pay app. You already got $15,000 committed to that job for subs and materials on order. Your allocation base, what we call real revenue in PFCC, is $25,000. That's the money available after the job passes through. Now you allocate that $25,000 using your target allocation percentages. Let's say you're running 15% JobEx, 5% owner's pay, 15% tax, 55% OpEx, and 10% profit. Here's how the money moves. JobEx gets $3,750 for next week's job commitments. Owner's pay gets $12,000. That's your paycheck, funded like clockwork. Tax gets $3,750, moved immediately to your separate bank. OpEx gets $13,750 to cover overhead through the next cycle. Profit gets $2,500 accumulating towards your quarterly distribution. Total, $25,000 allocated with purpose. Now, compare that to what most contractors do. Leave all $40,000 sitting in one account, pay bills as they come due, and wonder on Thursday afternoon where the money went. One method gives you control, the other gives you anxiety. Now, some of you may have heard the original Profit First book by Mike McAllowitz. Great book. It works for most businesses, but construction isn't most businesses. PFCC makes 5 critical changes specifically for contractors. First, JobEx becomes mandatory. The original system mentions subtracting materials and subs, but it doesn't force you to separate job costs in their own account. PFCC makes it non-negotiable. Job money must stay job money. Second, OpEx includes all P&L cash. Original Profit First focuses on P&L expenses. Profit First for commercial construction forces you to see that loan principal, equipment payments, and owner distributions are real cash leaving your accounts, whether your P&L acknowledges it or not. Third, owner's pay syncs to payroll rhythm. Most businesses can handle monthly owner draws. Contractors face weekly payroll pressure. PFCC wires your compensation to that weekly or biweekly cadence, so it's automatic, not optional. Fourth, tax lives across town. Both systems protect tax money, but PFCC operationalizes it by physically moving it to another bank. Theory becomes structure. Fifth, profit timing respects retainage. Original Profit First distributes quarterly on calendar days. PFCC aligns distributions with actual project completions and retainage releases. No spending profit before you're truly earned it. Here's how this works in practice. You pick one day a week, let's say Friday morning at 9 a.m., and make it sacred. Every Friday, you sit down, look at the weekly deposits, calculate your real revenue, and allocate money into 6 accounts. Step 1, add up deposits. Step 2, allocate percentages to each account. Step 3, record the transfers immediately in your accounting system. And step 4, pay bills from the correct accounts only. Job costs come from JobEx. Overhead comes from OpEx. Your paycheck comes from owner's pay. Never cross those lines. This discipline isn't optional. The moment you pay a sub from OpEx just this once, you destroy the visibility the system creates. Let me tell you what this structure prevents, because that's where the real value lives. Thursday payroll raids stop when tax sits at another bank. The 10 minutes it takes to transfer money back gives you time to think instead of panic spending tax obligations. Job costs hiding in overhead disappears when JobEx is mandatory. You can't accidentally inflate job margins or starve admin costs when subs flow through their own account. Owner skipping pay ends when owner's pay is funded automatically. It's not discretionary anymore, it's systematic. Phantom surplus from ignoring debt principal vanishes when OpEx includes every real cash obligations, not just P&L line items. Bookkeeping chaos stops when you record allocation transfers immediately, not at month end when you're trying to reconstruct 3 weeks of history. And here's the big one. Cash droughts between pay apps smooth out when your allocation rhythm matches your billing cycle. Weekly allocations prevent that feast or famine pattern that forces desperate decisions. All right, let's make this real. Here's your setup checklist. First, open some bank accounts at your primary bank and label them clearly: your income, your profit, your owner's pay, OpEx, JobEx. Second, open up a tax account at a different bank entirely. Make it inconvenient on purpose. Third, remove debit cards and online transfer access from profit and tax. Make withdrawal require deliberate action. Fourth, link your allocation day to your payroll schedules. If you pay employees every other Friday, allocate every other Tuesday or Wednesday. Timing matters. Fifth, map your allocation rhythm to your payout calendar so you're not running out of cash between billing cycles. This takes one afternoon to set up, maybe 2 hours of work, and it changes everything about how you see and manage cash. Now, here's the question everyone asks: Wade, what percentages should I use? The honest answer: it depends on your trade, your construction type, your geography, and your business model. A framing contractor's numbers won't match a commercial GC's. A specialty trade runs different margins than a general contractor. Start with PFCC's recommended ranges based on your revenue tier, but adjust for your reality. And here's the key move: embed those percentages into your estimating. Use what I call allocation calibrated estimating sheet. Build your target OpEx, owner pay, tax, and profit percentages into every bid you write. That way, winning work naturally funds your allocation post award. You're not hoping your percentages work, you're engineering jobs to support them. Start conservative. Maybe just put a few percentages points to profit, owner's comp, and tax until you see how your jobs actually perform. Reality beats optimism every single time. Then track and adjust quarterly after each profit distribution. Review how closely your actual allocations matched your targets. Use that data to calibrate next quarter. Here's the truth: contractors who separate their cash by purpose build businesses that work without them. Those who mix everything in one account build jobs that require constant CPR. You didn't get into construction to manage cash flow anxiety. You got in to build things, lead teams, and make a good living. The 6 account system gives you that. It's not complicated, it's just structured. And structure is what turns chaos into clarity. If you want the complete blueprint for this system, including the target allocation percentages and all the detail we didn't have time to cover today, grab the book Profit First for Commercial Construction on Amazon, or visit profitfirst.com to schedule a coaching call with our team. We'll walk you through setting this up specifically for your trade, your revenue level, and your goals. And if this video helped you see your cash flow differently, do me a favor, hit that subscribe button and share this with another contractor who's tired of wondering where the money goes every Thursday. I'm Wade Carpenter. Thanks for watching, and I'll see you in the next one.